Okay, guys, the word of the day is stagflation. And a lot of people don't know what that means because anybody under the age of like 40 something has never actually experienced that, at least if you're in the States. So, Travis, give us a little masterclass real quick on what stagflation is, why the markets are afraid of it, and why we all might be screwed.
Yeah, it is pretty much the worst economic outcome for a developed country other than hyperinflation. Stagflation would typically be defined as a very, very weak or declining economy coupled with very high price inflation. So not only do you have the economy deteriorating, but you also have people dealing with higher and higher prices. And so the consumer gets squeezed from both sides. So whether or not we're actually in stagflation yet is still to be debated in my mind. We've just started to see this stagflation narrative being thrown around on Twitter and in markets just over the past week or two. It's funny how price action changes sentiment, right? And I think that's a big part of why we're hearing that stagflation term being thrown around. I think it's a little too early to say we're in stagflation, but there have been a few pieces of economic data this past week that were a little concerning in terms of potentially areas of the economy weakening while also inflation starting to rear its ugly head in places where we thought maybe it was, it had been slayed by the Fed.
Yeah, and the markets are absolutely kind of running right now. We've got running to the downside, I should say. We've got Bitcoin that for the first time in about a year has broken key support. So we'll talk about what that means. We've also got the stock indices, at least, the NASDAQ right here that's starting to close below the 100. Now, we're actually recording this like an hour before the Fed announcement. So it's kind of funny because as soon as we're done, the Fed announcement's going to come out, but it looks like there's almost 100% probability that there's going to be no change. And it looks like the rate cuts that we were supposed to have by now just keep getting pushed out further and further. So yeah, does this add to the stagflation narrative where we're just going to have higher rates, higher inflation, and just lower growth and just a really mucky, ugly market environment and economy for years to come? I don't know. What do you guys make of that? Is this overblown? Is it just the start of something bigger? What do you see?
I mean, it does seem like inflation is becoming a problem more so in certain areas. Like Trav, we were talking earlier about the PPI report that came out and manufacturing prices being higher, and we're also in GDP, we're still seeing some things there that are a little bit concerning, but the GDP number was weaker, but the consumer was still spending on services. So it's like, you're right. It's very murky. It's very muddy right now, but it sounds to me like the Fed could potentially keep the market a little bit more, at least interest rates being higher does hurt consumers, not wealthy consumers, but it hurts the lower income people that are more so in debt than saving, right? Help savers hurts debt holders. And we're already seeing that divide. So I do think that the Fed keeping rates higher for longer is just going to continue to kind of beat down the consumer that we really count on. And I am a little concerned about that. So I think, like Travis said, it's a little early to talk about stagflation, but there are muddy waters out there that I think the Fed is in a really tough spot, because the Fed could, start lowering rates and start to kind of help some of that weakness that we're seeing in certain areas, but at the cost of potentially keeping inflation sticky and higher for longer. And then that's when stagflation, really kind of comes more into play and we're concerned more. So I think the Fed is in a tough spot here because I don't know, Trav.
Yeah.
It's a tough decision.
Yeah, the Fed has two mandates, which is basically to keep unemployment low while also keeping prices stable. And unemployment really hasn't been their concern over the past couple of years, really since, the pandemic, because unemployment is at historically low levels, or has been for the better part of the last 2.5 years. And so they've kind of got the leeway to be a little tougher on the inflation side. And that's exactly what we're seeing in the current environment. They're seeing numbers in the CPI that were a little bit hotter than expected over the last two prints. They're seeing things like the ISM manufacturing report today. Even though manufacturing is actually shrinking according to that ISM overall number, the prices paid component of it was actually at a multi-month high. And so those are the kind of signs that worry the Fed. You know, you mentioned last week the personal income and spending report. It still looks like consumers are generally spending at a pretty decent clip. The economy is still growing. Corporate earnings overall are still growing here in the first quarter. But there are signs of weakening. Starbucks, for instance, came out, they had their first sales decline since the pandemic. And so there are some signs emerging more and more that we're seeing that we're starting to question, well, is the economy really as strong as we thought? And then, of course, you have the sticky prices. And so the Fed right now is fighting the battle on the sticky prices front. But in a couple of months, they may very well have to shift to actually focusing on their other mandate, which is protecting employment. Because if unemployment really starts to tick up, then all of a sudden they're going to have to flip again. And that's where I think you could start to see the rate cut narrative come back. But it may be that September timeframe that the market's currently predicting, or even later potentially.
You know, something that's still just really mind-blowing and weird is the fact that mortgage rates are actually ticking back up. You know, they were in the kind of mid sixes. Now they're back closer to the mid sevens. And then look at the house price index month over month. I mean, February was huge. So yeah, it's a weird environment where affordability is like at all-time lows, but prices just keep going up.
Yeah, the
Weird?
median housing prices for new and existing homes are ticking back up. We thought we were getting some relief there. We'll see if that's a trend that continues, but higher rates are not leading to lower housing prices necessarily. Maybe in certain areas of the US like Austin, but overall.
Yeah, I think we are starting to see more supply hit on the existing home sale market. And so with higher rates, I think we will start to see a cooling again. So it's going to be very interesting. There's this push and pull. You know, I've said before, you know, the inflation problem sort of fixes itself over time in a way, because, you know, it creates that pressure on consumers. And so the Fed's job is kind of being done for them in a sense. When things get to like euphoric and people start spending and buying homes again, it starts to push inflation back up, and then rates go up and it kind of self-corrects. So I don't know. We're just in this like push and pull narrative or push and pull environment still. I did tell members of our community on Monday, even though we had a bounce in stock markets last week, I was like, I'm still very cautious because, you know, bond yields are not very constructive at the moment. The economic data is not very constructive at the moment. We're going to be entering a tougher seasonal period for stocks once we get to basically June through August. So, you know, that's ultimately, I think, going to provide some headwinds for the markets. But as an investor, if you're younger, that's also great because, you know, you could be looking at cheaper prices on stocks again, and on crypto as well, as you are probably about to point out, Chris.
Yeah, let's go ahead and do that. Right now, we've got prices that have snapped multi-month support. So 60K was kind of a big line in the sand. And I actually wrote about this in yesterday's Daily Doe. Or wait, no, was this today? My days are running together. This is today. Okay. So yeah, this morning. So I wrote this yesterday. It published today, but just talking about like the reality check for Hong Kong's crypto ETFs, because yesterday, Hong Kong actually launched Bitcoin and Ethereum spot ETFs, and the volume was kind of lackluster. And something to keep in mind is the fact that Hong Kong actually has their Labor Day today, which is May 1st, I believe. And so I just talked a little bit about like kind of the balance here and how I think it's just too early to really judge. And the ETF market in Hong Kong is like very tiny compared to the US markets. But I think that's contributing to today's breakdown is just, you know, whenever you have like a multi-month line of hope here, and then you start to see lower highs into that, the odds of a deeper pullback are actually much higher. And you can see this is actually so far from the all-time high in mid-March. This pullback is the deepest pullback that we've seen currently at the time of this recording, about 23%. And all the other pullbacks that we've had since the start of the bull market in early 2023 were in the right around that 20 to 22% pullback level. We've had, you know, 4 or 5 of those like real pullbacks. And so this is kind of the deeper pullback or deepest pullback that we've seen in a long, long time. And sometimes that's just due. You know, I think it's too early to really know for certain if the bull market is totally over, if we're going to go into much deeper, longer pullback. I think that it was absolutely healthy that we saw prices pull back in April because we were coming off of 7 green months in a row, which has never happened before. And so the odds of a pullback were actually really, really high. And so if you look at like a Fibonacci retracement from where the bull market started, we could technically be in the 40K range and still be in a bull market. So that's what I'm really looking forward to, is like, okay, can we get some washouts here? Market sentiment got pretty silly. We saw meme coins and just a whole bunch of like euphoria coming in. So what happens when the market gets too one-sided? Well, it needs to punish traders. And so I was tweeting about this and talking about, that 60K line of hope. And if that breaks, which it did just today, we could technically be in the mid 40s and still be in a bull market. We can see the 200 period moving average is currently right around that 50K zone. So if we can get a much larger washout over the next day or two, that could be pretty juicy. So I'm getting excited. As you guys know, whenever the markets are panicking, that's when I start to lick my chops and get ready. So we'll see what we can get going here. I think, Bitcoin is definitely showing relative weakness compared to stocks. It's kind of leading the charge on the way down, where stocks are still above their pivot low from April. Bitcoin is broken down from that pivot low. So we do see that in these bull markets where Bitcoin will lead on the way up and also lead on the way down. And so when we look at a chart of the Bitcoin price compared to the NASDAQ, you can see this is really the first pullback that Bitcoin's had against stocks since January. So we'll keep an eye on this, but overall, I think this is still part of a healthy bull market, at least as far as we can tell. But
I do want to remind everybody. I want to remind everybody that, when Bitcoin was running and hitting the new high, made that all-time high, barely over. The S&P 500 was running, making new highs just day after day after day. Remember that FOMO feeling that you were probably feeling, not us, but everybody else. They were probably thinking, gosh, I should be, I should be buying, or maybe they were buying. And now they're looking at it like, oh, shoot, I thought I was buying and it was going to keep going up. Just remember that if you loved the idea of buying Bitcoin at 70,000 or whatever it ended up getting to, and the S&P at, that high, you should really like the idea of buying it on these corrections, because what's Bitcoin
so you
at
mean
now?
buy low? What's that about? Why would somebody buy low?
I want everyone to remember that feeling of seeing the markets running and just wanting to be in and having those regrets if you had them, and look at this correction as that time to shine.
Absolutely.
And get a good deal.
Yeah, and my bad. I was trading all those meme coins and shit coins. I think I marked the top. Sorry, y'all. The local top.
That's what you get for throwing 90% of your wealth into meme coins, right?
Not quite 90.
Yeah. In all seriousness, we've also got kind of, as far as market sentiment goes, outside of the price, it's been kind of a dark week in crypto. There have been several legal actions. So we saw this week that CZ, the founder of Binance, got sentenced to 4 months, which this could have been way, 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 way worse. So I think he's actually the winner in this for, pleading guilty to anti-money laundering laws. Again, that's not my opinion about like, should he go to jail or not? It's just, when you look at this situation, it's like, okay, 4 months, that is definitely a slap on the wrist. I think, as far as like the US government's concerned. The other thing that just popped over the last 24 hours is Roger Ver has been indicted on tax evasion. So Roger, I hate this name, but some people called him Bitcoin Jesus in the early days. I call him Bitcoin charlatan. I mean, he was a big part of the Bitcoin cash wars, where he was trying to convince everybody to go for BCH. Look, whatever. BTC won over BCH, but what happened here is allegedly he sold a bunch of crypto in 2017 or 18, but he ceased to be an American citizen in 2014. So they're going after him and saying that he owes them like $50 million bucks. Whew. What do you guys make of this, Nikki, as a CFP? You know, what do you make of this? As whenever I put my crypto hat on, I'm like, I want to say like, hey, he wasn't an American citizen, but I know there's laws about that. What are those laws, and are they legit, or is it bullshit?
If he owned the assets before he renounced his citizenship, he owes the IRS money. Basically, that's why we haven't renounced. We've talked about this over and over, and it's like, you've got to pay an exit tax, and there's just no free lunch when it comes to trying to get out of U.S. taxation. They're going to get you one way or another. If you don't have a lot of assets, I guess that would be the time to get out of the United States, right? But if you bought all this Bitcoin, I mean, he was probably buying Bitcoin, I don't know, since 2010, maybe. I don't know how long he was buying it or how long he held it, but I'm sure he owned that Bitcoin before he left the US. So he would technically owe money, and yeah, that would be considered tax evasion. Maybe willingly, maybe not. Maybe he thought that he wouldn't get caught. Maybe he said he lost his Bitcoin in a boating accident. I don't know. But they're gonna try to get him.
Yeah,
This is why
I think
renouncing is tough.
the two things that the US government is just really hardline about is money laundering stuff and taxes, right? They couldn't get Al Capone on murder, but they got him on taxes. So
Exactly.
yeah, I don't know. Trav, what do you make of this, man?
No strong opinions here. I think like Nikki said, the US government's coming for theirs if they think they're owed it. So, that's you can play that out in court. Maybe he can get around some of it, but that's tough. That's tough.
Something tells me he's going to have a hard time proving that he didn't owe the taxes.
Yeah, I don't know. I mean, look, I know there's some people in the finance space that are like, I love paying my taxes, and it's your duty to. It's like, yeah, I guess I'd feel better about it if I felt like my money was being spent in the right places. But my God, man, like, last week the big news was Biden was trying to jack up the capital gains rates to 44%. We talked about that. And it's like, okay, are we just going to keep sending tens or hundreds of billions of dollars overseas while Americans are suffering and our infrastructure is falling apart in certain areas? Like, I guess I would just feel better about it if they were actually using the money wisely. But I don't know. Instead of jacking up tax rates, how about you cut spending and maybe spend a little bit more responsibly?
The great debate. The great debate. I have a feeling this has been going on since we were in diapers with America and people feeling that their tax dollars are not, being used wisely, I'm sure. But yeah, taxes suck. That's why you need good tax strategists on your side to help you try to reduce your taxation over your lifetime.
Yep. Or you could renounce and just move to an island. I don't know. I don't think there's
enjoy that
easy
exit
answer.
Tax.
Yeah. Yeah. We know a lot of people in Canada that are dealing with the same thing. I mean, the good news with Canadians is they can actually leave Canada and still be citizens and have like lower tax burdens. But us in the US, no matter where we are, we're getting the long arm of the US government's going to get you. There are some tax breaks like the foreign earned income exclusion and things like that, for maybe a few $100,000, but not any kind of real significant discounts. So.
Why would they?
Yeah.
Hey, we did get one positive regulatory piece of news out of the government this week.
What's that, Trav?
Well, after many, many years of fighting the battle, it looks like the DEA is finally going to reschedule cannabis from being as severe under federal law as like heroin and like the most severe drugs ever to rescheduling to Schedule 3, which will make it less severe under federal law if people, I guess, consume or transact in cannabis. So yeah, that is, finally about to happen. So I think the DEA is probably going to publish their proposed rule here in the next week or two, but it already got leaked to the media yesterday. And so the cannabis sector and investors in the sector have been waiting for this for years. and it finally looks like it's here. So yesterday, the cannabis stocks were up anywhere from like 30 to 75%. Today, though, it's a bit of a pop and flop because today a lot of those stocks are down big, but that's maybe a sell the news event. Still, I think it's overall good to see. Like, I think most people would find it very hard to argue that cannabis should be treated as severely as heroin. That's
Oh yeah.
Yeah, I think
most people-
we're only like a decade late on this to me. I mean, I thought by like 2015 we were going to be going down this path, but hey, I guess
Yep.
better late than never.
Yep.
Yeah, the government isn't exactly speedy on stuff.
That's
That's
right.
true. Yeah, I mean,
And it is an election year too.
Yeah, a lot of people are saying, it's the Biden administration trying to win votes, but really this didn't come from Biden. Like, this came from the DEA has been working on this for multiple years. And the HHS, the Department of Health and Human Services, issued a recommendation last summer to the DEA that showed all this medical evidence why cannabis shouldn't be in Schedule 1 as a drug under federal law. And so the DEA has been, I guess, working behind the scenes, I should put in quotes, because, this would have taken you and I probably like 48 hours to turn around. But the DEA has to go through a very long process and paper trail and looking at evidence and then publishing the proposed rule. Then people are going to give their comments for a few months. And then this could eventually actually become, an actual federal action, like maybe sometime late this year. It might even come after the election. So even though the Biden administration has been pushing for this and wants this before the election, these government agencies, take their sweet time. So
let's take a look at these charts. You can see how often I update my marijuana stock watch list, as half of these are like delisted now. But when we look at some of these tickers, I mean, it looks kind of interesting. Like, obviously a lot of these stocks are down massive from their all-time highs, but there is like some rounding patterns and some like accumulation range patterns. So I don't know, just I guess in general, what do you guys think about, these weed companies? Are there any that are actually profitable or showing like potential here, or are these all just still super high risk, terrible businesses?
So it's a little bit of both, actually. Some of these are still very bad businesses, but the others actually will benefit dramatically from this rescheduling news, because what it does is, for tax purposes, a lot of these cannabis businesses, particularly the ones that own things like dispensary chains, they weren't able to deduct expenses on their federal tax returns the way that a normal business would, because they're so severely classified under federal law. But as cannabis moves to Schedule 3, now you have the ability to be able to deduct normal expenses during business, during the normal course of business. And so you can actually see a huge increase in potential cash flows in these businesses from just owing less taxes. So this is actually a fundamental game changer for some of these dispensary owners who have started to turn, very modestly profitable, but now this could have a huge positive impact on their overall profit margins and cash generation. So there are some, out there. So a few of the big ones within the MSOS ETF are actually already marginally profitable and should become much more profitable in the coming years. Now, the flip side of that is there's a lot of competition, both from the black market and from the legalized market in states. So that's kind of the bull versus bear case at this point. But I do think some of these, like perhaps, your True Leaves, your Veranos, your I know some of the other
Aurora, maybe.
Aurora's a little bit different. Aurora and Canopy and Tilray, those were the big hype cannabis stocks in the previous cycle back a few years ago. Those are more like the growers. So those own, flower producing assets and things like that. And those have been a little bit tougher because they're competing more severely with the black market. Whereas the dispensary owners, at least they have assets in terms of the licenses where they can operate in regulated states. And so, yeah, I think it's still going to be tough, although the Canopies and the Tilrays of the world, the Auroras of the world, those are still like meme stocks. And so those can run, 100 to 300% in a hurry. And if you look at the long-term charts, there's probably a lot of meme stock traders saying, well, what if, Canopy and Tilray go to previous heights, which would be like, 10 to 50x in some of these cases. So,
Yeah.
you could see some wild moves still in these stocks.
Yeah, it does look like the growers, some of them have, like Aurora has a high short interest and a few others have high short interest. So these could end up being traders just on the momentum and the short
Yep.
the short positions.
And a very wise piece of investing advice that I read years ago that I've seen play out time and again is if you're betting on a sector, often the best thing to do is buy the best and buy the worst companies in that sector. And it sounds counterintuitive, but when a sector is rallying, sometimes the worst companies in the sector will actually go up in percentage terms the most because they'll go from being, totally washed out and near bankrupt to, 10, 20x type of returns in many cases. So buy the best and the worst if you're betting on a sector is often can be very profitable advice.
I love that. I love that. I mean, it's so true, right? Like everybody just wants to go to the big names, but it's like, hey, the things that have high short interest or are beat to death, those can have really big runs, like you said. And I'm looking here at the MSOS ETF. This is the largest
Yes.
marijuana ETF, right? Okay.
Yes.
So it was over 90% off of all-time highs. So during the COVID like meme stock boom, this was up huge and has been down in the dumps for over a year and is now testing multi-year resistance. So yeah, I mean, what do you think it's smart to try to like play the ETF or like go for specific tickers? What do you think might have the best volatility or biggest short squeezes?
Yeah, it's a great question. I think I've done a little bit of both. And again, I go back to the buy the best and the worst. And so if you buy the ETF, you're going to be a bit more diversified. So your downside is probably going to be a little bit more protected, but you may not capture the most maximum returns that way. So I do own a little bit of MSOS. I do also own, some individual players, including, a software provider in the industry. And then also, I think you could potentially make a case for a small speculative position in a Tilray or something like that. But you got to be very careful, obviously, as we see today.
Yeah. Yeah. It felt like we were kind of going back into meme stock and, meme coin territory. And right now it feels like the market environment has kind of shifted pretty quickly. Even if we take a look here at Total 3, looking at altcoins, we had a big washout from mid-April, and then we're still holding above that low. So it's unclear if we're going into a much deeper bear market or if we're going to hold at support here. But I know the big thing that a lot of you guys have been looking at this week and last week is earnings. So what do people need to know? What's been strong? What's been weak? What's the general vibe? And what are investors trying to pull from all the data that's been coming out with earnings?
Yeah, very mixed bag so far. We've had, pretty strong earnings from some of the bigger tech names like Google and Amazon. I mean, Google was up over 10% after earnings last week. We had Amazon put up pretty good numbers last night, although it's only up a couple, I think 2% today, but after hours it did initially popped pretty nicely. But if you look at the actual numbers, they're quite good. I mean, Google's revenue growth accelerated for the third quarter in a row. Operating income was growing between 40 and 50% year over year, which is a huge number. A big part of that, of course, is cost cuts are still flowing through for Google. Same thing for Amazon. They're really focusing on margin improvements. So that's helping. And then also you've had some pretty big wins on individual stocks, like for instance, Snapchat and Pinterest. I know Nikki has been involved in Pinterest for a while, but those were stocks where, people had kind of soured on them, particularly Snapchat. It was down like 7 quarters in a row after earnings until this most recent quarter. It finally popped and was up 25% because they had a little bit of improvement. So yeah, there's been some big winners like that. We've also saw some real stinkers, like, Tesla put up a bad quarter, but the stock actually gapped up initially. Starbucks put up a bad quarter. That stock gapped down today. CVS put up a bad quarter. The stock gapped down today. We've seen, things like AMD down today after a quarter that just kind of met expectations. So yeah, I would say it's definitely a story of winners and losers this earnings season. You really have to kind of pick your spots and be in the right stocks with, not too high of expectations.
Yeah, I think the same is true for the crypto market where, anybody that's been using the shotgun approach has really underperformed. So I think that's true. Like we're probably in a picker's market, right? Both in stocks and crypto. We're definitely not in an all tides rising. And something like 95% of altcoins have been underperforming Bitcoin. So seems like that's kind of true in the stock world where large cap, Google, Apple, Amazon, they've just been kind of performing better than I guess a lot of small cap.
Yeah.
It is kind of weird, Trav. Like we were talking about earlier, this muddy economic picture. and then earnings growth expected to be so strong for 2024. Like, it's kind of, it feels like an oxymoron. It's like, okay, the consumer's doing kind of, we're weak here, we're weak there, we're strong there, and then here we have earnings growth that's it's supposed to be 11%, I think, year over year. I don't know if that's still on track or if they've revised that yet, but I think
Yeah.
it's still pretty close.
Well, I'm glad you mentioned that, because looking at what we've seen, we've had just over half, I think at this point this week, we've had now about 60% of the S&P 500 report Q1 earnings, and the aggregate revenue growth, or I'm sorry, the aggregate earnings growth is only about 4% for the first quarter. But analysts are still expecting full year earnings growth to be close to 10%. That's interesting, right? Because if the economy is actually weakening in some areas, I don't see how corporate earnings growth is going to go from 4% to 10% by the end of the year. Now, it could happen, but
Right.
we may have a situation where expectations need to get brought down for corporate earnings. I mean, you can still say, hey, listen, earnings are still growing in aggregate, but it doesn't look like super robust at the moment.
Unless what it is these corporations are just getting more and more efficient and
Some of
just
them are. Some of them
hitting the
are.
bottom line, in a positive way with that. And that's what's causing the earnings growth. But that doesn't necessarily mean that the consumer is strong. So
Yeah.
maybe that's what we end up seeing. I don't know.
Yeah. Well, yeah, I think, there's certain pockets, like you mentioned, lower income consumers. We've already seen some stresses emerging there and things like credit card delinquencies. And so we know the lower income consumer is doing a bit worse. And we can
Mhm.
also see the savings rate has been coming down. So, people are spending down some of that excess savings from the pandemic. That's still happening. So yeah, there's definitely, companies that are doing well, especially on the back of cost cuts like Google and Amazon. But is revenue growth really going to be able to accelerate from here? And right now, I think that's looking pretty tough. We'll see.
Yeah, and there's a big difference between revenue growth and earnings growth that people need to realize, not to
Yep.
get that confused.
Yep. You can only cut your way to earnings growth for so long.
Right.
Well said. Nick, one thing I thought was really cool is the survey that you did on Twitter asking about people's risk tolerance. And it looks like nearly 2/3 of people that responded to you said they have a aggressive risk tolerance, which you're probably like an outlier in the financial advisor, financial planner space, right? Where, you like to
Yeah.
actually work with people that have higher risk tolerances, where I think most advisors are going to shy away and maybe even shame people like this, right? What did you learn from this?
Yeah, I mean, I guess being a active trader and investor myself, I guess I wasn't too surprised to see that a lot of my followers have a more aggressive risk tolerance. A lot of them are DIYers. DIYers typically are taking on more risk, whether it's through active trading and investing or business, entrepreneurship. But so I wasn't surprised to see that. But it is true that a lot of times in the financial advising world, advisors don't want to have that liability, right? Of allowing their clients to have this high risk portfolio. So usually Bitcoin is going to be shied away from, or they won't allow you to have the allocation to Bitcoin that you want. And that's going to shy a lot of people away from wanting to work with someone that can really help them, working with a professional that can help them make sure they get it right. But the thing about having an aggressive risk tolerance is you can do it very you want to balance. You want to find a win-win between being able to actually reach your goals while still giving yourself the ability to have those, high risk investments in your portfolio. So I kind of thought about this. You know how in trading we scale in and out of positions?
Mm-hmm.
I think that if you have a high risk tolerance, it's good to kind of look at your overall wealth and your income and everything and think about locking in, kind of scaling out some of that wealth for lower, just to kind of make sure you're achieving a goal over here and not taking on as much risk with it. But it doesn't have to be a large percentage of your wealth. You can still have concentrated positions and, still have that high risk investing in your portfolio. But I love the idea of like, okay, I have X percentage of my wealth. I'm going to lock that in. I'm going to scale it out essentially of the high risk aggressive investing strategy, and I'm going to reach a goal with it, or just have some peace of mind that this is done and I don't have to stress about it. So I think that having an aggressive risk tolerance needs to be done well. But there is a way to have a win-win strategy with it that helps you balance achieving your goals, along with being able to have the thrilling investments that people want to have, and the thrilling position sizes that people want to have. That's the other thing. Like, a lot of people probably in our community have Bitcoin allocations that most financial advisors would probably fall on the floor and have a heart attack, and
Yeah.
the immediate thing is going to be, oh my gosh, you need to diversify out of this. And there could be some truth to that, depending on what your financial picture looks like. And that's, our job to like look at that and say, hey, let's play out these scenarios and see what really, what fits. But shaming people for it, I don't think is the right thing to do, or trying to change their risk tolerance. You just have to find a way to work with it. But
Yeah, and I think we see this happen with people when it's like when their wealth gets to certain levels where it's like life-changing money, the goal goes from like aggressive growth to capital preservation. So somebody who maybe was a very aggressive trader and made a lot of money, it's like, oh, okay, now I got to this level. I don't want to give this money back. I don't want to lose it.
right.
I could be silly and take massive risks and compound and maybe double or triple in a year, but why not take a piece of that and lock it away and say, okay, I'm going to put this in a much more quote unquote safe place. And it's funny how beliefs like really impact people's positions, because we know a lot of people that are like, well, Bitcoin is the safest place to have all my wealth. And I don't disagree with that, but you've also got to recognize that Bitcoin has massive drawdowns. And if you're comfortable seeing, 60, 70, 80% of your wealth on paper go away, and then you're comfortable telling yourself, well, 1 Bitcoin equals 1 Bitcoin, that's fine. Where on the other side of the equation, and I think more people are probably in this camp where it's like, yeah, if they see their nominal net worth go down 80%, most people aren't going to sleep well at night. So I know I'm in that camp as well. That's why I keep my Bitcoin holdings well below 50% nowadays. I'm diversified between stocks, real estate, startups, crypto, obviously. But I think this is just a good conversation to have, because like you said, I mean, a lot of financial advisors either don't want to work with aggressive, investors or DIYers at all. And you also see a lot of them like on Twitter and Instagram, like shaming or like just talking shit to people that are professional investors or active traders. And it's like, all they're doing is begging for like, oh yeah, let me put you in an ETF and charge you 1% AUM for basically doing something you could do on your own. So I think the advisor space just needs a really, really big disruption.
The advisors laugh at my niche. Like, they just don't understand it. they think that I am crazy, but the fact of the matter is, just because someone is DIY doesn't mean that they can't, get a second look or have another viewpoint that could be very, very valuable to how they manage their money. Just because you're DIY does not necessarily mean you're doing it 100% the best way possible, because a lot of people just don't know what they don't know about investing, right? So I think most people are doing the best that they can, but I don't think it's okay for advisors that mock the active traders and investors and, make fun of them and say, how can you work with people like that? I don't understand. And it's just,
Well, it just kind of shows their own ignorance. And
yeah. And it shows that there's a need for people to serve that client base, basically.
yeah.
Which is what we do in the community, right? Like, that's why we do what we do in the wealth building community and give all the education and all the classes. And, everything we do is to serve that person that just wants to be able to make sure they're doing it the best way possible.
Mm-hmm. Yep. Trav, what do you think, man? What is like the biggest missing piece that you see the average person kind of missing out there, right? I mean, you come from the hedge fund world, but having been like in this space with us for a few years now, like what do you think is like something that the average person can do that can make just like a really big impact on their overall finances?
Ooh, that's a great question.
Yeah.
With a lot of potential answers I could give you there, but I mean, your average investor or your average individual, especially someone who gets into DIY, I think needs to understand the benefit of experience and education, because a lot of people get in, they have a lucky trade, maybe they have one big winner. I see a lot of people, for instance, going YOLO 100% portfolio in Tesla, and like that may work for a bit of time, that may have generated significant net worth for someone. But then the reality hits when there's, a tough time or a big drawdown. And, and that's when a lot of people learn lessons, or frankly, a lot of people learn lessons after 2021. The game seemed easy. Everyone was posting on Twitter their portfolio returns over 100% or over 200%. They were using leverage, et cetera. Again, that works for a time, but to actually have like sustainable long-term performance, I think that's really where a lot of individual investors could learn some things from the institutional world and the hedge fund world, where you look at someone that runs a successful fund, 15 to 20% annualized return over 20 or 30 years is incredible. And so, that's really what we should be shooting for. We're shooting for not like 10xing every 3 months or 6 months, or even in a given year or a given cycle, but trying to stay the course and actually generate that CAGR of wealth over time. And so, yeah, I think we talk a lot about different strategies to be able to do that. But having that expectation and understanding, I think, goes a long way to becoming a really successful investor.
Yeah, well said. Speaking of that, I actually found a good example to what we were talking about earlier.
Oh, this is exactly what I was trying to say.
Yeah. For anybody listening on the pod, there's a meme with a guy saying, "I'm an idiot. Why didn't I buy Bitcoin at 57K when it's at 74? Fast forward a couple months when Bitcoin's at 57K. LOL, I ain't buying that shit."
Yeah.
I mean, I think this embodies the spirit of just how people know buy low, sell high, but most people don't do it. They just can't give themselves to do it.
Yep.
Yeah.
Same is true in the S&P. Same is true in every asset class ever. It's like price will really affect investor psychology in a way that's not helpful. So you got to be able to break those patterns.
Got to do what's uncomfortable. All right, guys. Well, what are we looking forward to over the next week? What are the landmines? What are the potential white swans? Anything on the upside, downside landmines? What are you guys looking for and looking at? And I know literally in like 10 minutes, we're going to have the Fed announcement, which seems like it might be a nothing burger. What's your predictions?
Yeah, I'm guessing it's going to be a nothing burger, but with a small potential for the Fed to act really hawkish during the press conference, which could put, further downward pressure on on these markets that are correcting. So that could be a little bit of a landmine there waiting in the short run. We've also got a big unemployment report on Friday, so that can have a big market moving impact. And then we've got Apple earnings after the market close on Thursday. People in the crypto space might also be interested in Coinbase earnings after the market closes on Thursday. So those are some big potential landmines out there this week, and we'll of course bring you all our thoughts in the Daily Dough and here on We Talk Money.
Absolutely, Nick. What are you looking at?
Well, not financial advice for anybody, but for my own portfolio, I'm looking at these dips. I'm looking at this Starbucks sell off. I'm looking at this AMD correction. I'm looking at dips in some names that look possibly tradable. So I will definitely be watching the S&P 500. It is starting to look like it's shaping into a continuation of that correction. So remember a while ago I was talking about, I would love to see a 10% correction in the S&P 500. We got to about 5 and it looked like we were going to bounce back to, all-time highs for a few days there. And I was like, damn it. I really wanted to see that deeper correction. So I might get what I wish for here, and I'll be watching that very closely to see if this is going to continue just the original trend downward. I think 10% would be very healthy on a technical perspective, from a technical chart perspective, and from a fundamental perspective. So that's what I'm looking at these dips.
Cool. Yeah, me too. I mean, the next week I'm going to get a much better picture about the Hong Kong ETFs after they get through their little Labor Day holiday, and also, you know, kind of look at either the continuation or the outflow of capital from the US ETFs. We saw them trading at a little discount to NAV, net asset value. So that's kind of an overreaction on the downside that should normalize. But yeah, I don't know. That's really kind of the main thing, is just to get a much better read on like average flows. Obviously, when prices are coming down, I mean, capital's flowing out, but just looking at this dip on Bitcoin, looking at the 200 period moving average and staying the course.
Remember, if you loved Bitcoin at 70,000, you'll really love it the lower it goes.
Yeah, I love
Or
this
you should.
Yep.
At least.
Not financial advice.
Not financial advice, no, but
but a good lesson nonetheless.
But a good mental trading, investor psychology, you know, thing to think about.
Yes.
Cool. All right, guys. Well, if you're not already a member of the wealth building community, go to wetalkmoney.com/community. Also go to dailydoe.co to check out our newsletter. That's every Monday, Wednesday, and Friday. And yeah, this is I think a good time in the markets to pay close attention to the data, both on the fundamentals and the charts. And if you guys have any questions, you can go to wetalkmoney.com, submit a question for the show. And yeah, thanks guys. We will see everybody next week.
Cheers.
See ya.
Take care.